My name is Andrey Krahmal, and as Stan has suggested, I am a Chief Compliance Officer for VEN. And we're very excited to be here and to be joined by these panelists. And I just want to start by having each of you sort of give a little bit of a background as to what you're doing and what you've seen in the last year or two that it surprised you in the space in terms of some of the things you're seeing that are exciting, or some of the things that we haven't heard about that are coming down the pipeline.
That's a big question to start off with. My name is Liz Rabban. I'm with Celsius Network. I first want to thank the Bermuda government. I want to thank Stan, and I feel like that was a very hard act to follow. So I'd like to thank Sir John for his comments. One of the things I just want to pick up on that he said that in India, a country of 1.4 billion people, all he needs 100 thinkers. Look around this room, and maybe this room and the colleagues that you have in the space are those 100 people that can create such massive global change. Celsius Network, I don't know, raise your hand if you know us. That's about half and half. All right, I have some work to do here. We started about 2 years ago. I joined them about 4 months after they started. We are an app that lets you do two things. One is take cash loans against crypto assets. We're not the only one, but where we hit a nerve is that we also have a way for retail crypto holders to earn interest. And this is where we've found an extraordinary gaping hole. And I think this is something we'll touch upon in the summit about liquidity. Is that globally, there's almost no place for anybody to earn interest right now. Most countries have negative yield. The US is heading there. And I think that what we're building and what I'm building personally is a way for people to monetize their current assets instead of paying toll collectors every step of the way. So that's on the other side. And the other side of our business is institutional lending. And we can talk about that a little bit more on the panel. So that's sort of what we do. What I see happening, now we're in the building phase. And what I hope is happening is that the actual blockchain is going to sit behind whatever it is that we do in our initiatives. I mean, when you turn on your computer in the morning, you don't actually think about TCP/IP, right? Nor should you. And overall, I'll keep repeating the theme of when it comes to liquidity, we need massive global retail adoption to create the liquidity that everybody thinks is going to come from the institutions, and I don't. So what I think we need to do, and all of my colleagues on the stage and you in the room, is need to build easy-to-use services, apps really, that give people true value in a trusted and safe and secure way, which is where the regulatory environment that Bermuda is promoting is an excellent mark along the way.
Great.
That was fantastic. I'm just going to basically touch on some of the stuff you brought up. For those who don't know me, my name is Julien. I work for XBTO, which is a Bermuda company, and that's got a DABA license as of this year. I think we're the third company to do that. So in terms of what's happened this year, what Liz brought up is very interesting. We're institutional traders, so I don't really look at the retail space particularly closely because it's not our target market. But everything that's happened in terms of trying to come up with more efficient ways to allocate capital in the digital asset industry is probably one of the big areas of progress that we've seen. And to your point, looking at lending products has been probably one of the greatest advances there. I would add to that the derivatives market has actually boomed as well, which overall basically gives you a slightly different landscape to what it looked like a couple of years back when a lot of the trading interest was trading the spot markets. What it's transitioned towards at the moment is, I would say, the spot market is almost not that different from what it was about a year ago, but everything that's linked to kind of leverage in the market has evolved dramatically. There is a very positive component to this, which means that if you're using derivatives to express more sophisticated views about market direction, that's now available to the traders. But there's also, I guess, a risk component to it, which is, once you start introducing leverage into any given asset class, you've got to kind of be quite mindful about the implicit risk that comes with this, and how to even identify, I guess, what you would call a bubble, I suppose, in terms of the use of that leverage.
And do you think that inherently the digital assets are better equipped to handle that systemic risk, or do you think we're dealing with something that we're still figuring out and getting our feet under ourselves in terms of what that looks like?
It's a bit of a double-tiered consideration. I think on the one hand, digital assets in their structure are better equipped because of the kind of transparency you can have in monitoring, how coins are being utilized, are being traded. On the other, there's another layer on top of that, which is the kind of governance that's actually been applied between the companies that are trading against each other, lending to each other, and I think the risk is going to come from that end of the spectrum. So the asset class is better equipped, but ultimately it does come down to governance points, which I think that in an industry that's still in its infancy, I think when it comes to its grasp on governance and risk, could lead to problematic situations.
Great.
Hi, I'm Aristotle, Andrulakis. Please call me Aris. I co-founded a company called Alkemi 2 years ago, and we started off looking to become an arbitrage fund, and then we quickly realized, okay, we're taking another sort of Wall Street approach, cut, copy, and paste, and putting that on peer-to-peer technology. So we weren't really harnessing the full potential of blockchain. That's when we realized there's a bigger opportunity here to create an inter-exchange connection between exchanges. So we provide them essentially a VWAP price index where they can...
Explain what it is.
Oh, I mean, we can go deeper into it, but essentially it's telling exchanges, okay, you are too high versus another exchange or too low. And instead of having to settle with the counterparty exchange, Alkemi has aggregated decentralized liquidity. So we have a decentralized liquidity pool which exchanges can settle against. So it removes a lot of friction in the system. So, that's the inefficiency or arbitrage piece of what we're doing with the exchanges. And then on the liquidity side, which is really interesting, you've got, let's say, a $200 to $300 billion aggregate crypto market cap. And then when you distill down and figure out what's the available balances, and we're mainly targeting institutions, there's at least 18 to 25 billion sitting out there. And that's just passive liquidity looking for a home. So when Liz was talking about offering these higher spreads, I mean, yeah, it's really attractive, especially look at public equity markets, bond yields. You're going to get, negative yields to 2% real. And then now in crypto land, you're, 5 to upwards. It's very, very attractive. Now, certainly risk always plays into everything, risk reward. So understanding your Sharpe ratio and, what that looks like, and custody risk. But I'd say the opportunities are very compelling there. So that's sort of the broad theme I see. Digital assets growing from institutions because of the yield spread, essentially.
And do you think a company like Alkemi would have been possible had it not been for blockchain? And what's the sort of real-life equivalent of Alkemi would have been in the non-blockchain universe?
Yeah, so that's a great question. I think my mic, there we go, thanks. So the real-life equivalent would be like a Virtue Financial or Jump Trading that does high-frequency market making. So we don't do market making, and we're not high frequency per se in the sense of speed, but we're high frequency in the sense of we do a ship ton of trades, or we facilitate for exchanges to do a lot of trades. So, there's a lot of critique of public equity markets and centralized exchanges, but they do a lot of things very well. And decentralization, when you marry the two and you do it in smart ways, that's where the real innovation piece comes in.
And I'm Rob from Salt Lending, or Salt now. So, I think I've worked there for 2 years, and the reason I first joined was just because, I learned about blockchain a long time ago, Bitcoin specifically, and saw quickly that it was an international business or an international opportunity for people to have commerce in a common language. And I think that what we've seen, or what I've seen over the past 2 years, is that's really interesting from a perspective of you can have credit from something that you already own. But what we've seen kind of come to fruition in the past year is other assets are starting to be tokenized. And so if you can own a fractional part of that, or it's something that you already own that's becoming tokenized, it gives you sort of this instant credit that you didn't have previously. And it unlocks the ability for you to leverage that in some ways and be able to access credit. So that's one of the things that we're working on that I've seen come really, really, truly to fruition through stable coins, which is probably the first thing that makes sense. But then you start to see things like gold that are verifiable that come to be tokenized now. You can own a fractional piece of that, where previously maybe that was harder to do. And as that, talking about what Sir John was talking about, it's the new normal. Things are going to be tokenized. And so if there's ability to access credit and unlock value from that, that's something that we want to be able to provide and extend that to as many people as possible.
Great. So there's a lot of exciting things happening. You've touched upon, I think, a little bit about risk and introduction of systemic risk. Do you think that the industry is getting better at pricing the risk and in terms of providing some of the credit, lending products, borrowing products, derivatives, et cetera? Or do you think we're still in the infancy and we're still learning a lot of things about this underlying and the derivatives associated with it?
I think we're still in the infancy of that process. If I looked at the credit market, basically that's the existing digital assets today, and we look at pricing there, it's very, very fragmented. So you can have the same conversation with two different counterparties where if you're, let's assume you're a borrower, for example, you can borrow from someone unsecured at like 6%, and you go to somebody else, same question, and they tell you it's going to be at 30% LTV, that's loan to value, so a very heavily collateralized loan at 10. And I think that's really a function of that transition that we're observing now, especially with people like Celsius and what you guys are doing at Alkemi as well, where I think people are going from having this latent capitals, they're just sitting around, they just don't really know what to do with it. It's a small industry, so you kind of know each other, and there's embedded trust in there. And that's the kind of defining factor in how you basically kind of almost price your risk, which to people like us is fantastic, incidentally, because we've been around for a long time, and I feel we get good funding on the back of this. But I think as you transition towards how do we systemize that and scale it, then you've got companies who have got a dedicated role in actually really thinking hard about how do you price risk relative to counterparties in this industry. And if you start actually then using also, I don't want to use the word deposits for your retail investors, but retail investor, because you're not a bank, but if you want to use retail investor Bitcoin effectively and then can lend it on, then suddenly there becomes a much stronger onus on the companies to make sure that the way that they can price that on is going to be done responsibly.
Look,
so
everything that we do is in the interest of our depositor and their assets.
Exactly.
We're giving them what is essentially hedge fund returns on their assets that they've never had access to, but they are the only, that's what we think about every day, every night. That's it. And when we lend, we have a very, very careful risk assessment.
And that changes everything, right? Because if you go from basically lending your own capital towards counterparties that you know and trust, to actually lending somebody else's capital, as a company, well, provided you do your job properly, your mindset is going to be entirely different. But I think it's still early, and therefore it's still a very, very fragmented market when it comes to actually seeing how a risk gets priced and how people even understand that risk.
And in terms of what I'm hearing is that there's a process of broader adoption in the market, both from the institutional side and the sort of individual investor side. And do we, as an industry, is there an obligation to distinguish between the adoption that is happening for positive reasons, negative reasons? Is it purely speculative? Does it matter? What are your thoughts on that?
What was
the question is, as there's broader adoption in the marketplace, should we be distinguishing adoption for the right reasons, for positive reasons, and negative reasons? And should we distinguish between adoption by institutional investors and adoption by retail, so to speak?
The latter, for sure. The former, I think it is still speculative, and I think we have not quite crossed that gap into a less speculative environment. That will happen with massive retail adoption. I do think that look, you know, I'm going to keep hitting on this theme. I think that we are also, in this case, there has to be good trusted centralization. I mean, it will not be purely decentralized because of the risk involved, because of this, you know, the need for global adoption in a trusted environment. In the last year, people have entrusted us with over 400 million of their crypto in a year. Why? Because we are building everything for trust. And that includes an element of centralization. Let's be clear that what they're building here in Bermuda with the Sandbox for Innovation is a centralized format. So do we have, in order to have this massive adoption, both institutional and retail, we have to scale with trust. And risk is part of that, certainly. It doesn't mean we can't have a risk portfolio, right? We're not saying no risk. Nothing is no risk. Deutsche Bank's leverage 52-1. I think there's a little risk there. So, people say, well, it's unsafe, it's in the bank because we have FDIC insurance, A, which has never been used, and B, which is the promise of another bank to bail them out, basically. There's some risk there. So I think that I'm not sure where I'm off on a tangent now about this, but I think we will have growth with these trusted environments.
Right.
I think one of the things that interests a lot of institutions about coming to places like Bermuda is that it starts to create a more global conversation that is sort of creating these standards of trust around centralization that we can all kind of agree to globally. And so when you're talking about partially secured products or leverage and risk, that we at least are speaking the common language. And so then it's like we agree on these rules and we can all play by those same rules. Then it's something that makes us more global, and we have to be friends, right? Because we're all operating in the same spot, which is, again, like I think I had the opportunity to go around the island yesterday a little bit, and you kind of see this really cool place where everyone lives really close together, and it's this experiment where you have to be friends, where you live and you play and you work together. And I think that in a global landscape, people forget that pretty quickly. So Bermuda's a good example of a place that kind of gives us that opportunity. So.
And what, if any, is the role of regulation in this? Is it, Liz, I think you mentioned, complete decentralized systems are unlikely to be sufficient in terms of earning that trust from both retail and potentially institutional investors. Is there a role for regulators here, if any?
Yes, there is a role for regulators here. I think that the generalization that I make, hopefully, is accurate when it comes to the regulators in the room. But I feel that regulators, first and foremost, are here to make sure that the most vulnerable investors are adequately treated. And I think as a corollary to this is that there's also no, untowards, I'm talking about kind of most criminal behavior that's actually associated with, the transactions that any asset class is supporting. So with that in mind, there's 100% a need for regulators to be a part of the conversation, but also to kind of actually drive and enforce the rules that will ensure that those two things at the very least are not going to happen. When it comes to Bermuda, I guess, I can speak from experience now because we've got a license from the BMA. And this is actually the 1-year anniversary of the Digital Assets Business Act this month, if I'm not mistaken. I think that the jurisdiction has taken a massive step ahead of most other countries in trying to basically define a framework that is sensible, but also kind of allows companies to kind of scale in a responsible way and in a way that's going to most definitely satisfy international standards with success. And I suppose that when we ask that question quite regularly, what is it about Bermuda that to you guys is attractive? I would say the fact that there's now dedicated legislation and a regulator that actually understands the asset class probably comes as number one, because as operators in a world that you assume needs to be regulated, taking out that risk and that ambiguity about how you're meant to operate is is a very powerful thing.
I would just add on this that, again, blockchain technologies are so potent because it's peer-to-peer, you to me, right? So with that means a delayering of middlemen friction fees. I mean, just coming here from Toronto to Bermuda, I was at the currency exchange and talk about getting clipped. I mean, those rates are insane. So I think all of the things that are happening in blockchain are just so, so important. Transparency, pricing, again, removing of friction, and regulators that understand that digital currency, digital waves are, this is the change that's happening in the world, so embrace it. So we need those types of environments where you can iterate, you can experiment, and just come up with elegant solutions to a lot of these problems. But the banks, God love them, there's billions of dollars of fees generated. I think you're going to see. I mean, the whole point of blockchain is to compress a lot of these and put them into more productive channels.
I think we need to have regulation with and for inclusion. Most of the time, regulation is built to exclude a class of risky behavior, risky individual, risky products. And here, we have the opportunity to regulate for inclusion, regulating risk. And so what I want to make clear is, and this is the same thing, I would like to, one of the things that crypto and asset-backed lending does is eliminate credit scoring. Because what credit scoring has become is how much they can charge you. It has no bearing on somebody's ability to pay back. So in the end, we want these regulations and we want these trusted environments for, and specifically for, inclusion. That's my pitch, anyway.
Agreed.
Oh, you agree? Okay. Great. The other thing I'm thinking is that I would like you guys to touch upon is, we've had the Bitcoin, there's a sort of lore and story behind that, and it's been extremely sort of fast-paced development and evolution in this space. There's not yet widespread adoption. My argument, my view is as follows. What are we still awaiting some meaningful breakthroughs in this space? Do you think there will be that sort of killer application or use case for cryptocurrencies or digital assets that are still down the pike that will lead to more utility, faster payments, et cetera, et cetera? What shape may that come in, if any?
Well, I guess what we've touched on today is almost the kind of what's happening with capital efficiency in crypto today. We've touched upon regulation, and I guess to your point now, what's actually happening with the underlying assets here? Is it just about Bitcoin? Is it about other coins? And is there going to be some kind of proven utility, i.e. that killer app that's going to really drive mass adoption? My view is that in the current market, speculation and I guess the primacy of Bitcoin as a store of value is probably still the most compelling argument that actually the industry can make, and that every other coin is really a slight compromise on some of the kind of fundamental features of Bitcoin. Once you say this, just because it's compromised doesn't mean there's not scalability and there's no utility to it. But in that context, I think we're still in the experimentation phase. What I would say is very compelling about this year, and that you touched on it actually, is the use of stable coins as instruments that basically can be used for, at the very least, kind of treasury needs and offsetting some of the market's volatility. That in itself, I think, will contribute to adoption because you take away some of the volatility in the market. We're still using tokenized assets. But I would say the kind of killer app, I don't know,
Network.
I don't even know what it's going to look like at this point, to be honest. But I'm very optimistic about how things are moving, though.
Yeah. So you mentioned stable coins. Liz, I think you have a very strong view on the nomenclature.
Yes, can we as a group come up with some other name for them? When I literally try to explain, and once I get breakthrough trying to explain what they are, every single person from 8 to 80 understands what we can do with them. But there's a hurdle when it comes to stable coins. That word doesn't make sense to anybody. So I pose this out to you guys, if we can come up with something.
Do you guys have a view of on what's coming down the pike in terms of breakthroughs, or what might be the next Bitcoin or digital asset related killer app, if any?
I mean, I think, we've talked about this a little bit, but I think Bitcoin is the killer app at this point for sure, because of all the sort of properties that it exhibits and the things that people enjoy about it and like about it. But I I think we're at the point where someone introduced me to this analogy, and it's not even really an analogy, it's just sort of the learning process of what something is like this. I was introduced to Bitcoin for the first time in 2013, and I thought it was very cool and didn't really quite understand it, but just, I at least was introduced to it. And then about 2 years later, someone else ended up talking to me about it, and I was like, oh, this thing's still around. And so it's sort of this like small period of time where you have to, as a human being, I guess maybe there's something inherently built into us where you have to just, when something's new, it has to have time to grow, and it has to have time for people to build on top of it. And maybe we can accelerate that process through building trust and building applications that people can rely on over time. But I think until we have the ability to introduce this concept to people in a way that they can understand it and where they are, I think that we're kind of stuck in the adoption part.
Well, I think we have to
But as
give
long as it
something
sticks
of value to them, and I leave the institutions out of this. We need them in this space, but it's not the app environment. It's not mass adoption. The institutions play a critical role here. But if we are not giving value back to our users 100% of the time with everything that we do, then we won't have that killer app. And there are apps other than mine that give value back, but we are looking to that. Think about it. WhatsApp. You ever pay for WhatsApp? Raise your hand if you use WhatsApp. Exactly. Literally, Amazon. I mean, the crypto space needs this blowout app. And in that space, we have to give value and transparency now back to our users every day.
Yeah, those are excellent points. And I think part of the value, again, is just, coming from a capital markets lens is really looking at the yields that are out there and the yields that are in the digital world, and that's just simply compelling, and it's going to draw more retail unis, institutions, all of those folks in this market. Volatility, velocity of transactions are very important, right? So you absolutely need public equity markets over the last 10 years. Volatility is compressed, and this is actually it's a bad thing overall for a lot of stakeholders.
I agree, but and bearing in mind that I'm very invested in this sector doing well, but I think that yields are have to be sustained by something, right? So if at the moment the yields in the market are only sustained by the kind of internal velocity of the trading, then that's great, but that's probably not as robust as how you and I would think about yield, which is basically I'm lending to someone and there's a stream of cash flows which is represented in actual economic activity that actually allows that company or that borrower to pay me back. So it still goes back, we're going full circle a little bit to this kind of utility and killer app thing. It is right now, I think, this is a speculative space. Right now, Bitcoin as a store of value has a credible story to tell, but we still haven't reached that stage where the WhatsApp of digital assets has emerged, bearing in mind that there is an enormous amount of talent and dedication that's going into it, and that we just need to know to be patient and actually trust in all the efforts that have been deployed in that context.
Great. Unfortunately, we're running out of time. I would like to thank our panelists for their sort of thoughts and ideas, and it's been a fantastic discussion.